Good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN AM for Wednesday, October 27th, 2021. And our top story today, the impact of inflation and Fed interest rates on mortgage rates and what you need to know before taking a mortgage. Joining me now to discuss this and a lot more is Carl Delmont. He's the Chief Executive Officer of Fremont Corporation. Carl, great to see you. Thanks so much for joining us on the program this morning.
Pleasure to be here. Thanks for having me.
We're going to talk mortgages and rates and how to find the best mortgage possible in today's environment. But before we do that, let's kind of level set for the audience. And you're an expert in the mortgage and industry. So let's talk about kind of how you and Fremont kind of see what's going on in the mortgage industry. What are some of the current trends?
Well, I mean, unfortunately, one of the trends is rates are moving up a little bit, and that's to be expected. I mean, when you think about, we've been at pretty much all-time lows for a little bit of a while now, right? We've nowhere to go but up. And Powell, the Fed Reserve Chairman, has actually signaled that tapering will probably happen this year. And I think what's happening now, you're seeing investors in the bond market, mortgage-backed securities markets, taking advantage of that and maybe being a little bit preemptive. So, rates have moved up, but they're still very, very low. Most surveys say people can still save money at today's rates by refinancing. And, if you're looking to purchase a house, I always tell people this. In the mortgage world, we qualify you based on paper, right? We don't look at your cell phone bill, your car insurance, all those other things, because that doesn't fall into the equations that Fannie and FHA require. So what you really need to do is look at what is your housing cost now? Are you paying rent? How much are you paying in rent? What are your utilities? And then look at your budget and really do an honest look with yourself and your partner if you're buying a house with someone else. And look at what can you actually afford. Forget about paper, because no one lives on paper. Figure out what you can actually afford. And then when you talk to your loan officer, say, look, this is where we want to be. And then turn around and try to find a mortgage in a house that fits that equation.
Really, really good advice. And I think the hardest thing for all of us is to be honest with ourselves, whether it comes to nutrition, health, but also our finances. I think a lot of people put their heads in the sand because you don't want to see the real picture. Going back to the mortgage rates, can you just describe, there's a relationship between interest rates that the Fed sets to mortgage rates, but it's not direct. So if the Fed goes to raise, that's the Fed funds rate that it lends to other financial institutions. Mm-hmm. But what does that mean? How does that translate to your world? Mortgage rates.
So there's an old axiom that I always like to say, and it's if there's good economic news, that's bad for mortgage rates. If there's bad economic news, there's good for mortgage rates. But yeah, to your point, when you look at the Fed, when they actually raise their rates, that's going to affect prime. So if you ever bought or took out a home equity loan or have a credit card based on prime, those are the things where it'll be impacted the most. But when it comes to mortgages, a lot of people look at the 10-year bond, and that's an okay benchmark, but really you're looking at mortgage-backed securities because those are what really drive the mortgage rates. And right now, the Fed is the biggest buyer of both treasuries and mortgage-backed securities. So you've probably heard the term tapering. What that means is the Fed's going to just purchase fewer of those each month until they get to a point where they feel comfortable. And that's really their foray into saying, what's next after that is it's kind of like the appetizer, and the main course is going to be the Fed turning around and starting to raise the federal funds rate.
Yeah, thank you for that. Let's talk about the different types of mortgages. And I'm not an expert in your field, but you are. I'm very familiar with the 30-year mortgage, but I believe there's also a 15-year mortgage as well. What are some of the key differences that you would expect if you are looking for a mortgage out there?
So, I mean, everyone wants to pay off their mortgage early, but let's be honest, most people don't stay in a house more than 7 years. So when you're looking at a mortgage term, at least in my opinion, and this is not a one size fits all, but for most people, take a look at how this fits into your monthly budget. And odds are mortgage payment is going to be the biggest monthly payment of your budget. So a 30-year mortgage, what happens is if you keep the mortgage the whole 30 years, typically somewhere about the 20th year is when you're paying it back about equal principal, equal interest. Conversely, if you're paying on a 15-year mortgage, it's much, much sooner. You could do a 10-year, 15-year, 20-year, 25, 30. What I tell people refinancing is what you want to look at is, do you have a target date? Are you looking to retire at a certain time? Are you looking to do something at a certain time? Then what you do is ask your loan officer, could you amortize for me what, say, a 21-year payment would look like? And then take the 30-year, but pay the 21-year payment they told you. And if something happens, transmission goes up, you decide to remodel a kitchen, your kid gets into a school that costs more than you thought, then go back to the 30-year payment. It might take you 23 years instead of 21, but again, now you're dictating what the budget is and you're in charge.
Carl, when it comes to refinancing, is it still advantageous for homeowners now, given rates have gone up, I guess, a little bit and could go up? Is it advantageous to think about that refi now if you've been putting it off?
Yeah, I mean, rates have gone up somewhat. I mean, we were below 3, now we're just over 3. So, there's a little bit less savings. But Warren Buffett even came out and said that the best hedge against inflation is refinancing your mortgage. Because when you think about it, you look at back in the 80s when prime was 18, 19%. People were begging their banks to do longer than 5-year CDs because they wanted to make 14% on their CDs. It's the flip side now. If you can lock in for 30 years, 15 years, whatever the case may be, a low mortgage rate, it makes sense. And a lot of people think about refinancing. It's just lowering your rate. It's so much more. I mean, you can use it for renovating your house. There's even arbitrage. I had a client once that called me and he had 3 houses. One he bought when he was single, one he bought right before he got married, and then one he and his wife bought. And all of them had different time frames and everything else. And he had actually attractive rates in all 3. But I sat down and played with a couple different numbers and said, hey, I have an idea. If you turn around and refinance your primary residence, take that savings and put it towards the first rental property, you'll pay that thing off in 2 years. Now take that savings plus that payment, go after the second house. You'll pay that thing off in 3 years. So now we're 5 years into the future. Those 2 savings, those 2 payments he's no longer paying, plus the amount that he has with the savings of the first mortgage on the refinance, he'd actually have all 3 mortgages paid off in about 7.5 years. But if someone just looked at rates, there was really no savings between the rates. But using that as a sort of arbitrage way, it actually made a lot of sense for him.
Yeah, and I think what you're talking about, that long-term planning in the retirement industry, we're always talking about the long term. And that really has applications to other financial instruments like mortgages. Carl, I need to take a very quick break. When we come back, we'll offer up some tips, tricks, and trends, things you need to think about when you're taking that mortgage. You're going to want to stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Are you stuck with a low credit score? A credit report and score that's causing you to be denied credit or pay higher interest rates than others for the same things? Then do what Terrence did and call Credit Repaired for your free credit evaluation to help restore your credit.
I started thinking about buying a new house, and my score wasn't where I needed it to be. I called and spoke with one of the representatives, and we just had a good conversation, and I liked what he was saying.
Just one call for his free credit evaluation was all it took to start back on the track to repairing his credit.
I'm seeing the deletions and I'm getting the reports, so I know something's being done. it does make a difference to me.
All it takes is one call to get started.
Credit repair has given me a second chance to have a better credit score.
Don't let a low credit score hold you back another day. Do what Terrence did and make the call for your free credit evaluation.
Call 800-819-4152. That's 800-819-4152. Again, 800-819-4152.
Welcome back. We're talking this morning to Carl Delmont of the Fremont Corporation. Carl, thanks so much for staying with us this morning.
My pleasure.
Yeah, this is fun, really important information. You know, Carl, there are a lot of first-time home buyers out there, people that are really interested in getting their first home, building up equity, and being able to, you know, live, I guess, the quasi-American dream. What are some tips, tricks that they need to think about? Because they may not have a home to offer, they may not have equity in which to show, to get a loan. So what suggestions do you offer to them?
I think, like, to your question, really with everything in life, you want to be proactive, not reactive. So if you think you're going to buy 3 months, 6 months, even 12 months from now, what you really want to do is sit down and take a look at your credit report. And you can always go online, but those are typically consumer models. So they'll give you a gauge, but it's not super accurate. But find a loan officer that's willing to work with you and tell them, I'm probably a year away. And you'll be surprised how many will tell you, well, call me in a year. The good one's going to say, well, let's see what you look like now. And they'll pull your credit, tell you where you are, give you the steps you need to get a better credit score. And then you want to sit down and look at your budget and figure out where you want to be and everything else. The other thing you want to do is research all the grants and programs. There's a lot of them that are just basically specific to the county or the state or the city that you live in. There's a lot of different grants that can help you. Grants, remember, you don't have to pay those back. There's other first-time home buyer programs. I know Maryland has one that helps you pay off up to $40,000 of student loan debt when you buy the house. So other states have things like that as well. So you want to look around and find out what all the options are. And then, of course, after you figure all these things out, make plans that make sure that you're not going to go out and charge up your credit cards. There's a TikTok video a couple of weeks ago where a girl went on there and said, oh, my God, I opened a Home Depot account and just lost my mortgage approval. Now I can't buy a house. So there's little things like that you want a loan officer to warn you, hey, don't do it. It's like that, eat this, not that. When it's mortgage, it's don't borrow this, don't open that account, all those things. So they can give you the whole blueprint so that you know what you're doing, so you don't make those mistakes that could cost you and maybe delay or maybe prevent you from buying a house.
Yeah, that's really important and something I wasn't aware of. So if you are a part of that buy now, pay later mentality, and that may not be the best thing long term in terms of paying down debt, but that's a whole nother issue. You need to be aware of big purchases that are going to appear on your credit score or that a loan officer will look like. And you really bring up a great point, Carl, about these, and we did a show on this recently, about some of these credit score apps not really giving you a complete picture. Really important to talk to a professional here.
Yeah, again, it's not one size fits all. And, I've seen people who talk to the wrong loan officer, and that loan officer said, oh, you have $1,200 cash. Let's pay off this one credit card. And their score goes up 4 points. Whereas in the right hand, you might be able to pay, say, $117 towards that, say, Target credit card, get maybe 15 points and still have, over $1,000 in savings that you can use for moving and other things there. So, and to this, you also want to make sure that you get a solid pre-approval. There's a pre-qualification. Pre-qualification is you call a lender and you say, I make this much. Here's my social security number. They pull your credit. It's based on what you told them. A pre-approval, it takes a little bit more work and a little bit more money for the lender. But what they do is they actually underwrite the loan as far as they possibly can. So obviously they don't have the appraisal or warranty or anything else, but basically they're looking at your taxes, your pay stubs, everything else. When you're out there, one of 15 people bidding on a house, it's going to make you shine a lot more than the other prospects out there.
Yeah, very good to know. Carl, what other things go into the application? How important is your income? But also, what if you were making rental payments for the last 10 years? What kind of gets baked into this? And is there any hope for people who have rented but now have the capital to buy a home?
Yeah, it's a great question and very timely, because here's what's going on. In the past, well, even to this day, if you pay rent, it's not going to go and impact your credit score. It's just not reported, so there's no way to categorize that. But Fannie Mae and Freddie Mac came out and said, you know what? There's so many people who could possibly become homeowners. Well, how do we take advantage of that? So what they're doing now is they're actually allowing credit for your rent. So what happens is they can take your rent and then the underwriter looks at it and it allows you to qualify under conventional financing. Now, it doesn't affect the pricing. You're still going to look at the scores and everything else, but it's an added boost. The other thing that they just came out with is the credit scores. So it was always the middle credit score of the both borrowers. So if you say had a 750, a 700, and a 650, 700 middle score. If the person you're buying a house with was 700, 650, 600, or 650 middle score, they would have to use that. In this case, they would use the top score for the qualifying purposes, but you would still be for add-on fees and everything else, and the pricing would be on the lower to middle score. And then they just came out and said they're going to do desktop appraisals, which is another perk because that's going to speed up the process as well, because we have fewer appraisers due to the SAFE Act back in 2010. And the ones that are still out there are so busy right now. So it's really, really tough. And then if you have a natural disaster like a hurricane or anything like that, then those appraisers have to go back out again and verify that the house is still standing in good shape. So the people who are in line next have to wait even longer because you have to go back to the first person. So this desktop appraisals is going to help out a lot. But it really does seem like FHFA, which oversees Fannie and Freddie, is really trying to encourage home ownership and make the right decision. So it's very, very encouraging.
Yeah, absolutely. You should get credit in my mind. You know, obviously I'm not a lender, I'm not a regulator, but in my mind, if you're making payments and it shouldn't be a deleterious effect. It should be a positive effect that you made consistent payments. Last question here, Carl. Mm-hmm. What are the fees associated with taking a mortgage? Just so we're aware, not necessarily your fees, mm-hmm. but just fees in general. What do we have to be aware of when we're getting that first mortgage?
So you're going to be recording fees for the courthouse, everything else, origination fees, appraisal, earnest money deposit, which will go towards your down payment. There's a number of fees. But what I tell clients is when you hear like no closing cost loans, right, what that means is you're going to pay a higher rate. So the easiest way to think of it is like this. You have the lowest rate, but it'll probably have the highest closing costs. You're going to have the highest rate, which will have the lowest closing cost. What you want to figure out is where on that scale should you be? And typically it's a little bit more down here, because if you go over here with the highest rate but the lowest closing costs, your break even is farther down the road. So it could be moot if you have to go that way. But maybe you don't want to pay a lot of fees and not worry about the lowest rate. So typically, because what happens is lenders, they can mark up the rate and they can make a profit and use that to offset some of those closing costs for you. So if you don't have a lot of money, that's another way to do it. You can actually sort of subsidize yourself by taking a slightly higher rate. The other thing is if you're putting less than 20% down, most programs have what's called mortgage insurance. There's some programs out there you can do lender paid, borrower paid. It's a lump sum. So what happens is in exchange for a slightly higher rate, it's built into the payment versus having that monthly payment. But again, you want to look at all your options, because if you take the conventional mortgage insurance, after a certain period of time, if you have the equity and everything else, you can actually ask to have it removed. So there's a lot of choices. And I think that the best thing a good loan officer can do for their client is to go over all the choices, not just say, oh yeah, here you go, here's your rate. You should go over, here's the program or programs, here's the term, here's the pros and cons of each, here's one with mortgage insurance, here's one with lender paid, here's one with borrower paid. And it gets a little confusing, but again, this is the biggest probably purchase of your life and the biggest monthly payment of your budget. You should probably know going in. The last thing you want to do is imagine going to a restaurant and just order some off the menu. And after you pay the check and you walk out and you hear the waiter talking about the stuffed lobster special for $20. You're like, man, I would have had that had I known. Right, that's a small thing, but if you're going to get a mortgage that big, you probably want to know all the things on the menu before you make that decision and walk out the door, right?
Yeah, really important. And I lied; it's not the last question. I've got one more question because you bring up a really good point. I've got about a minute left. Okay. Where do we go if we're first-time buyers? Where do you go to find what the right resources to educate yourself first about the environment, but also how to find that right lender?
Yeah, I mean, the internet is full of good information and full of bad information. What I would say is, talk to people at work, talk to your family members, ask them, hey, did you buy a house? Did you refinance? What was the realtor? What were they like? Did you like them? What was the loan officer like? And get that testimonial, because that's really going to be someone from you trust, right? You can call around everything else, but a lot of lenders are really good at marketing, but maybe not quite as good at actually getting the deal done. So what I always tell people is, there's two R words: rates and results. You kind of want the results, because if someone offers you an amazing rate, but they can't deliver the settlement, there's just going to cost you so much more money. So go with a trusted lender, do some investigation, some due diligence, ask around, and a lot of them will have testimonials. Make sure that they're real, not just made up. But again, if you ask around, that firsthand referral, that's probably the best way to go about doing it.
Yeah, really good. It's so important, given how complex a lot of these deals can be, whether it's mortgages or financial instruments like investments, how you really need the guidance of someone who has the experience and information. Carl, always great to talk to you. Thanks so much for joining us, and we look forward to having you back on the program again very soon.
Look forward to it as well. Appreciate it. Thank you.
That wraps up this episode of BRN AM. Have a topic of interest, somebody you think we should talk to, drop us a line. And don't forget, for all the information in retirement markets, technology, personal finance, so much more, check out today's edition of our daily newsletter, The Morning Pulse. We're back again tomorrow. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
Are you being audited and do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a Tax Doctor now for a tax emergency analysis.
Call 800-224-6439.